The Reserve Bank has upwardly revised its inflation forecast for Australia's economy. Inflation was expected to end this year at 4%. Now it's 4.5%. Today's statement on monetary policy also revealed that inflation will fall to 2.9% by the end of 2025. I caught up with Deutsche Bank economist Phil Donaghoe a little earlier and started by asking him if the RBA will need to lift rates again.
Yeah, look, unfortunately, I don't think the RBA is done. I think we need to see rates a little bit higher from here. I've got one more 25 basis point hike in my profile. I think that can still happen as soon as the next meeting, which is in December. To get there, we're going to need strong data over the coming month, including, very importantly, the wage price index for Q3, which is out next week. But, the data has surprised the upside all year. How confident are we that that's going to turn around the next month? So, my sense is we need to go higher, very possibly as soon as December.
And if the RBA doesn't lift in December, obviously they get the rest of that month to observe the economy, and then all of January with the sort of Christmas spending and all that comes through.
Yeah.
So then we've got the February meeting. Could they potentially lift then?
Yeah, look, that's exactly right. I think, right here, right now, my call is for a terminal rate of 4.6, and if I'm wrong on December, then I won't be throwing my view out the window and saying, well, the terminal rate is 4.35. I think it's much more likely that hike just gets pushed into the early part of next year. And as you say, of course, there will be more data. We will see how resilient households are through the Christmas period. But certainly, I think we should be bracing for another hike here.
Oil prices, rents, property prices, they've all increased really this year. That's sort of a part of the economy the RBA can't really control too much. It's all sort of external factors. So how does lifting the cash rate really help bring down inflation at the moment when the big thing's going up in price? The RBA can't really do anything about it.
Look, it's a very fair point. Unfortunately, with monetary policy, we only have one tool. Yeah. We only have one interest rate. And so those factors that are driving inflation higher, that are probably outside of the scope of the RBA. I think, unfortunately, what that means is the RBA just has to push harder on those things that it can control. So you're right, it is not ideal, but when you have a clear target, which is inflation 2 to 3%, you've only got one tool to get it there. It's the thing you've got to use.
Well, that's right. So the Reserve Bank this week said inflation, they're not expecting it to get to the target band until the end of 2025. That seems a long way off.
Yes, yeah, that's exactly right. And when you look around the rest of the world, you look at our peer economies, every one of those central banks has cash rate in 5%, 5 point something. I think one of the reasons, as much as we are focused that we're so painfully here in Australia with rising rates, it actually is the case that the level of rates here is lower. And I think part of that reason is because we have this flexible inflation target. We've been very used to that here in Australia. It's been around for 30 years. The RBA, relative to its peers, is a little bit more tolerant of inflation outside of the band, below or above. And so actually, you're entirely right that it does seem like a long way away, but it does help the case for getting a less volatile business cycle. You don't need to push the unemployment rate up as high as you might otherwise have to if you had to get that inflation back into target earlier.
So coming up, we've got wages numbers and we've also got unemployment. So we know wages growth's accelerating. What are you expecting there?
Yeah, look, we're expecting, I think we're going to end this year. So the number we're going to get for Q3 next week, I think is going to have a 4% something on it. I think we're going to be closer to 4.5% by the end of this year. Now, that is a lot stronger than where we have been. I think we're going to see an acceleration. We're seeing in weekly enterprise bargaining data that the department give us now, we're starting to see quite a notable acceleration in wages in the second half of this year coming through. So that's going to come through. That does not help the RBA's case. We've been lucky so far with relatively soft wage growth. Lucky for the RBA, I should say, not so much for workers perhaps, but that has helped the RBA's case. I think we're going to see an acceleration. And unfortunately, that does mean probably interest rates need to be a bit higher.
The unemployment rate has been very resilient as well this year. I think the most recent reading, it was 3.6%, which is close to 50-year lows. Where do you expect that to go?
Yeah, look, that's an excellent question. My sense of the labour market right here, right now, is that we can move pretty much at these levels for another 6 months. Now, that's probably not what the RBA are going to be expecting, but we've got a couple of indicators which I think do a very good job of telling you where monthly labour employment growth is going to be sitting. they're telling me that even with this very strong migration, we're doing enough work. Demand for labour is strong enough to absorb that increase in migration and, in fact, keep the unemployment rate moving sideways. Again, if that is true, that's another problem for the RBA. The labour market, unfortunately, is too tight. We can see that in acceleration in wages. We need to take some of that pressure out to get inflation lower. So again, it brings me back to looking for another rate hike.
Philo Donaghoe from Deutsche Bank. Thanks so much for your time.
Thank you.